Welcome back to another update. So before we find out whether this is beginning of a new correction, a prolonged correction, or a continuation of an existing bull market, do note that I just give out a couple of updates midweek whenever it is important. So do scan this QR code and you'll be able to access those updates as well. So first, it's important to understand what has currently happened in the market. And whatever limited updates I've given out in the last 4 5 months, I've stated about pockets of market being overvalued and certain pockets being relatively fairly valued. And essentially, that is what has happened. There are a lot of theories floating around. This is due to China. This is due to President Trump winning the election. But it's difficult to find a reason why the markets have corrected. Sometimes markets correct because that is the healthy way forward. And I've seen this numerous times happening in the past also. And yes, as analysts or media anchors, you then begin finding what probable reasons could be making the market move the way it has been moving. So, what has corrected the most? See, that pocket of the market has corrected the most where valuations were reaching 2 standard deviation, 3 standard deviation from mean valuation level, sometimes even beyond that. So, leave aside media sector. But oil and gas, PSU Bank, Realty, PSE, CPSE, Railway, Defense, Auto, FMCG, all these sectors were sectors that had rallied a lot in the previous up move. And these are the sectors naturally have corrected a lot more. What has corrected the least? This is important to study at this point because one of these sectors is going to be a massive leader ahead in case the market were to bottom out soon. And which were those sectors? IT, digital, healthcare, pharma, banks, private bank, and even the small mid microcap space roughly has fallen just 10 odd percent. A lot of stocks in the small mid microcap space has fallen 30-40%, but again, it was those stocks where there was a lot of froth buildup that was happening. So I would term this movement that has happened in the market as a healthy correction as of now. I use the word as of now because there are a lot of data points that are unfolding, and I'll take you through those data points as we progress in the video. So the number of stocks that are above 50 DMA are at the lowest level we've seen in the last, I think, 15 odd months, which is just about 10-11%. And these are only liquid names. There are a lot of illiquid names also, but I don't consider that when I'm doing some breadth analysis. The number of stocks below 200 DMA naturally has shot up to its highest level that we've seen in the last 15 odd months. Currently, I think about 65 or 68% stocks are below 200 DMA. And then stocks with a lower high, lower low structure on a daily time frame chart. Again, if you look at it, the small mid micro cap space on an average, about 50% stocks are in lower high, lower low structure on daily time frame. For the total market index, it is above 70%. Nifty 500, 200, 100, and Nifty 50, again, it is closer to 70%, which means just about 30% or 33% of the broader market is in a higher high, higher low structure. Now, the important question here at this particular point, and I'll explain this chart in a while, is whether this particular move that we've seen from 26,500 to now, I think just at 200 DMA, about 23,500, is this a counter trend move of this particular uptrend, or is it the new trend within which we move up and again start falling? Now, there is an interesting fractal developing. Fractal means something that has probably happened in the past. It's actually mirroring itself in the present. So if you pay attention, point one is a prior trend. Here we have a prior trend. Then price goes into consolidation, marked in a blue region, goes into a consolidation. Then we have an up move, again an up move here. Price again heads into a consolidation, again a consolidation. Then the fourth wave begins, which is here. Then we see a retracement happening, which is this green vertical rectangle, again, green vertical rectangle, retracement happening back to 200 DMA. And here also it was happening very closer to 200 DMA. Then the 0.5 happened where we rallied, and then eventually here we again started falling. And this was a complex kind of a correction. So it's difficult to answer as of now whether this is beginning of a new complex corrective cycle in the market. I would tell you, take things slow. Take things slow because it is going to take some time for these things to play out. As of now, the consensus obviously is on the downside and we can move lower quite easily. But in this particular case also, if you were there in this particular phase, trading in this particular phase, you just saw a vertical counter trend rally developing and then this complex correction continuing in the market. So I wouldn't necessarily be too optimistic in the very short term. As of today, if you ask me to guess, then I would tell you my educated guess tells me that this is a healthy correction going on within a larger bull market cycle. The problem with this is that the definition of healthy correction can change very quickly. As of now, the broader markets have fallen 10-15%. Some stocks, junk kind of stocks, a lot of stocks have fallen about 30 odd percent. So froth has gone off the system. That is healthy. But if we start dipping another 5-10%, then we may get some panic reaction also on the downside. And let's not forget, from this move of 26,500 to 23,500, there hasn't been any meaningful counter trend move. As of now, all rallies, even on shorter time frames, are being sold into. So what is the approach that I'm taking? See, whenever correction happens in the market, that is actually an opportunity. But you have to be careful in not being too optimistic too soon. So what I do is, I create a test portfolio, which is 10 to 15% of account size. So let's say your account size is about 1 crore. You can at every potential dip in the market, create a test portfolio that you can tolerate in terms of losses. So for me, it is 10% of my account. For you, it can be 2% of account, 3%, 4%. That is fine. With that portfolio, then you need to assess whether the broader market improvement is happening or not. In this case, I would tell you, as of now, today, most of the indices are trading below 50 DMA. This is something I was updating on my Insta profile also. And if you start seeing sector stability coming back, price attempting to move above 50 DMA, while the feedback you're getting from your portfolio remains positive, that is when you need to look for sector leadership. Then those names you need to add to your watch list, and then quickly scale in when you see breadth improving, most of the sectors moving above 50 DMA, a structure of higher high, higher low again beginning to form in the market. And see, during this process, it is usually the sectors that fall the least in a corrective move are the ones, couple of these sectors will become the next leaders of a mini cycle in the market. That is how sector rotation actually plays out. So whenever I get the signs of broader market stability, then I would start looking for names within sectors that are breaking out before something like Nifty, Nifty 500, Nifty 200, Nifty 100. That is how you identify potential leaders in the market. Now, this particular move on the upside, whenever it comes, I don't know whether it will come or not. That is also a guess. As of now, this is just a fractal. This particular down movement could actually come about if there are some radical decisions that will be taken when the new US government takes charge, which is President Trump and his team. Because ultimately, if there is a lot of volatility that comes in the global market through some decisions, then that is going to have negative impact on India also. That is why this is not the time to be too brave. If you've been watching my limited updates post budget, I have mentioned this many a times that you had to be a bull with the foot in exit door, just because of how certain pocket of spaces, sectors, and small themes in the market were moving. Stocks were going up 200, 150%. So many IPOs coming out. It does have an impact on the market. So now coming to knowing your risk profile at this stage. See, if you're a conservative trader who is into systematic investment plan, systematic trading plan, then every dip is an opportunity for you. Break down your money into really small chunks and keep investing whenever Nifty is making a new high, new low that is, or Nifty 500 is making a new low. If you're an aggressive trader like me, who goes behind one-time scaling or pyramiding approach, then timing is essential. And this is where you need to sit out till the point you see some meaningful improvement coming in the market. The first indicator of improvement would be your test portfolio. It would stop falling. And within that test portfolio, let's say you have 10 odd names you select, some of those names will begin moving into double digits. That is the earliest cue you get in terms of a potential reversal coming in the market. Now, market is all about cycles. There is this decadal cycle where you get an amazing opportunity once every 8 to 10 years. So the 2000 crash, 2008 crash, in our market, the 2017, 2018 small mid micro cap kind of a crash, then COVID. These kind of opportunities come only once in a decade, or maybe eight odd years. Then there is this 3-year cycle, which I currently feel we are into. A bull market that is 3 years old, that is seeing retracement, sharp sell-off in certain pockets. So I think we are in this 3-year cycle wherein we are seeing some meaningful correction. And then there is this 1-year cycle that you saw in 2021, 22, 23, wherein the market gives 5 or 7% correction and then again starts moving up. So I think we are in this 3-year cycle where we can see potentially a complex correction playing out. Complex correction is when market moves down, which is currently it's doing, then it moves up, again pulls in a lot of people in the system, then again it starts falling. and then we have a time-based kind of correction. So I think we are in for that. Obviously, no one knows with time, you'll be able to see this better. So what patterns you need to go behind? It is Stan Weinstein breakout. It is Mark Minervini VCP, that is volatility contraction pattern. It is William O'Neill's high tide flag pattern. And the two more patterns which I recommend is relative strength breakout. I'll just come to this, and cup and handle. So these are the 4-5 patterns that are bread and butter for me. And this is where I specialize. You can just pick a couple of these and stick with it. In your test portfolio, it's not that you need to be random and pick out 10 names. In your test portfolio, you need to go behind stocks that have a clear trending relative strength on the upside and that are exhibiting any of these 5 patterns. That is either a stage breakout, that is stage 1 to stage 2, a VCP, that is a base at 50 DMA and breaking out, high tide flag, which is nothing but a flag that breaks out within 3 to 5 candles on a weekly time frame, and of course cup and handle is something that William O'Neill himself has covered so many times. So this is the Minervini contraction that you're seeing at 50 DMA. The structures that I am looking into for my test portfolio are the ones that have broken out recently out of a base and coming back and testing this particular region. And look at the relative strength. This is the sample, or this is the template that I can give you in terms of looking into stocks that have recently broken out after forming a base at 50 DMA and currently pulling back, while the relative strength overall remains very healthy. Again, look at the stock, a beautiful contraction right at 50 DMA, attempted breakout in the stock, but look at the RS, clearly trending higher. This is the template that I will follow in order to build a test portfolio. Now, what are the risks in market? See, you got to take it slow. And I would ask you to just pause and read what I've written here. Remember, India was a market that was leading global market returns, both in terms of GDP, in terms of stock market performance also. So personally, I won't be in a rush. Just as a market tops out when its leaders stop moving up, in our case, it was defense, it was railways, it was capital goods and engineering, real estate, it was PSE, CPSE, all these sectors stopped moving after budget. And then you saw these newer names coming up. Metals were moving up, banks started falling less, it started supporting the market more. So just as you see towards the end of a cycle, leaders giving up, this can be applicable to the global market also. Is it that we as a country who were leading the bull market are the first ones to fall, and then the beginning of 2025 we'll start seeing other markets also tumble? That is a theory that only time will tell whether this particular part is playing out or not. Or we are the leader of the global market in terms of GDP and return, and now we are just seeing some routine price and time correction. Again, this answer I'll only be able to give you in the next 2-3 months because it's very difficult to say what is currently going on. So you need to build a test portfolio and take regular feedback from it. You have to scale in only if you see the market stabilizing. And this would be confirmed by sector leadership and your portfolio performance. Again, which sectors have fallen the least? Are they attempting to stage a breakout? And what is your portfolio, that is test portfolio, doing? Is it something that is stabilizing and moving to new highs every single week? That is something you have to see. The next big risk is the new world order. There is a new government in the US that is going to take charge in 2025. There are a lot of things happening in the US political arena that will have a lot of impact on the world stock market. So you will have to see whether whenever we get this move in the market on the upside, which invariably we will because that is the nature of market, you will have to carefully determine which stocks will take the Nifty higher. So let's say we stabilize at 23,000 and we go to 25, which stocks are taking Nifty there? Or let's say we fall directly to 22 and then have a move up to 25. Again, you have to assess the leadership. Which are the stocks and sectors that are taking the market higher? Because the quality of those sectors and stocks is something that is going to tell you whether this is a regular correction in the market or we are setting up for a deeper time and price correction in 2025. So always remember, correction is an opportunity in the market. But within this, you have to focus on stocks with strong relative strength. Relative strength should be trending up despite the recent corrective move. I'll also tell you, stick to limited stocks. Let's say you go through 100 or 200 stocks over the weekend, select the top 10 names that you feel are in a wonderful structure, and that becomes your test portfolio. Leave everything else aside. Believe me, there is a lot of time. If the market were to turn up and a new trend would begin that is in the direction of a long-term trend, you will get plenty of opportunities. In the short term, your aim has to be to not lose a lot of money. That's all. Then you got to follow something like a progressive exposure. So progressive exposure is you start slow, that is you're building a test portfolio, and then you add whenever you see that your portfolio is holding up well despite the market moving lower. So whatever returns you get, let's say on the 10 or 15% of money that you put in the market, use that as the cushion to scale into names which are already doing well, rather than finding some new opportunities. So that is what is progressive exposure. Now, Mark Minervini has spoken about this a lot. There are a lot of other traders who have some different ways of taking progressive exposure, but I just explained how I see this particular subject. Now, expectation of return, and this is an important thing. See, the markets have been trending so beautifully over the last 2-3 years that people think that is the norm, or that is how the markets usually move up. Actually, that's not the case. Last 2-3 years have been exceptional. I don't think that period is going to come back soon. So I think whatever test portfolio you begin to build today, the returns I think you'll begin seeing only, I think, 16 or 18 months down the line. That is the kind of market we'll currently be into. If there is something that changes, let's say January 2025, President Trump comes and whatever he has said about tariffs or disrupting things that have been going on in the last 2-3 years, if there is not too much of major change, then I think we are going to be okay. But if whatever he has said, he's going to implement it, then you got to wait out. You got to wait out and see how your test portfolio behaves, whether you get cushion on that or not. When the next retracement comes, then you got to add to the names that are already doing well. So that is an approach that will have clarity, only over the next 2-3 months. So it'll all depend on whether this is a short-lived correction or it will prolong longer. And yes, no one can know this beforehand. I have to reiterate this because a lot of interviews that I heard during the Samvat episodes that were going on, I was not seeing any of the stalwarts of the market raising a lot of concerns about things that can potentially go wrong in the world. And yes, India is in the sweet spot. I don't say it is not, but India is slowing down at the ground level. Things are not that great. You can see consumption and spending power of people getting affected. That you can see in the FMCG and consumption sector results that came out. So there's a lot of work that needs to be done. So if trouble starts mounting in the US market, also face a lot of problem and a much prolonged time and price correction. But if things in the US turn out to be okay, then I think maybe in this quarter or maybe next quarter, Indian markets would start to bottom out, and markets would tend to move up again. But there are two things you need to keep in mind. Number one, wait for stability in the market. The easiest way you can assess stability is by seeing how many sectors are moving above 50 DMA. And number two, do not forget your test portfolio is your biggest indicator. If your portfolio does not stabilize after you've selected the top 10-15 names with beautiful relative strength structure, higher high, higher low structure, then there is no way that the broader market is going to stabilize either. So have simple data points, track how many sectors are above below 50 DMA, the structure of those sectors, and number two, combine it with your test portfolio. So whatever updates I would have to give you midweek or whenever something happens during the market, particular day, if it falls a lot, rises a lot, I'll definitely make some notes and put it out. Make sure you follow me and scan the code. You will get regular updates for the same. So I'll see you next time. Take care, be safe, and have a great weekend ahead.